We've done the contribution variable format income statement in chapter 4. We went through different things. We talked about how this per unit cost is really good because it's variable in nature and you can use things. We compared it to what we considered our traditional approach, doing our sales minus our cost of goods sold to get to our gross margin or gross profit. And the same thing under the variable where you do sales less variable expenses. So if we look specifically just at the variable statement, you will see that our product costs or our variable costs per unit or our contribution margin per unit just includes our variable costs. It does not include fixed overhead. Manufacturing, which is a product cost under our regular, what we call absorption costing or GAAP accounting or external accounting reports. Under absorption costing, you take all these product costs, you put them together, they go to inventory on your balance sheet, and then when you sell them, they go to the income statement. Under variable costing, we haven't done a balance sheet yet, and we've always done where the number of units sold is exactly the same under both systems. We're now going to change that up. And so what you need to know is under a variable costing system, you're only using your cost of goods sold for the variable component. On your income statement, this fixed cost is all your fixed costs, your selling and admin costs, as well as your manufacturing overhead costs. So our per unit cost that we use to go to the balance sheet only has the variable costs in it, which is why it can't be used for external purposes. So under what we call absorption costing or generally accepted accounting principles or external financial statement costing, you put all your factory overheads. Yes, also your direct materials and direct labor, but the only difference here is overhead. Both your variable and fixed components treated as a product cost, go to inventory, and then when you sell the product, it will go to cost of goods sold. Selling and admin expenses, yes, treated as period costs because they are not product costs. On your contribution margin income statement, and when you're doing contribution margin costing, only variable costs for product costs go to your product on the balance sheet. All fixed costs, meaning fixed overhead and selling and admin fixed, go onto your income statement. And yes, your variable selling and admin costs still go on your income statement. But all fixed costs are written off against income in the period that occurs. Some advantages though to internally, because it's only going to be an internal statement, internally using this is it eliminates any distortions to income if you have a volume change in the number of units produced. So if you think about it, if your production costs, fixed costs are just spread over the number of units you produce. You produce more units, your fixed costs go down per unit. You produce less units, your fixed cost goes up per unit. So there can be distortions from year to year depending on how many units you're producing. So using just variable costing just keeps it to the variable product cost of the product, and the fixed costs, well, they're just a fixed cost of the period anyway. They really don't have anything to do with the number of units produced. So why don't we just put them on the income statement? And that's what you do for a variable costing statement. The other advantage is it reduces the dysfunctional incentive to overproduce, which I sometimes refer to as a perverse incentive, or that you're being incentivized to do the wrong thing. So you're the production manager and you're told, hey, product costs are presently $5 per unit. You get it down to $4.50 per unit and you'll get a bonus. Okay, well, all you need to do is produce more units such that your fixed cost per unit is less and you can decrease your product cost per unit. So you're actually doing something wrong because you don't need those extra units. But now if you can just increase the number of units you're producing, you can really easily get your bonus. If instead you only base it on the variable cost per unit and said you'll get your bonus if your variable cost per unit of your product decreases, now you as a production manager actually have to go do a bunch of work to get your variable costs to decrease. You know, you have to go and maybe change suppliers or negotiate better deals or do something else, but you can't just increase production. Your variable cost per unit is going to stay the same. Some disadvantages, of course, what's fixed and variable is always subject to manipulation. It does produce misleading cost figures because you are ignoring those fixed costs. They are being incurred, they are product costs, they should be included in the cost, but they're not. And of course, you can't use it for financial reporting because you should have your fixed product costs in there.